Well, welcome everybody to our Q2 quarterly wrap up. Thank you for joining us. Just so you all know, the presentation is being recorded. So if you'd like to see this presentation after we're done, just go ahead and send an email to myself at medgar@edgarinvestment.com and I will get this to you. So let's go ahead and get started. So a little brief overview of what we're going to cover today. We're going to talk a little bit about what's happening at Edgar Investments. We're going to talk about some hot topics over the quarter, a little bit of some market summary, look at some country returns. We're also going to look at the Edgar Sector Rotator. That's a new thing that we've got going on that I'd love to show you guys about. We're going to look at US stocks, international stock performance, as well as some fixed income. All right, so what's happening at Edgar Investments? Well, in case you are thirsting for more knowledge about the markets, we do write a daily blog. That daily blog can be found on our website under the Investment Learning Lab tab. There's also some other great resources there from Dimensional Funds about investing, some videos, so definitely check out the Investment Learning Lab. We also have the Syndex, which is a Edgar investment model that I actually came up with this idea with my wife about 20 years ago when we were in grad school. And the model is based around stocks that are sort of correlated or have something to do with the 7 deadly sins. So gluttony, greed, avarice, pride, etc. Now, these are fundamentally sound companies, good investments, but they just have something to do with the 7 deadly sins. And we've been running this model for a year now, actual money in that model, and Syndex has performed really well. We also have a new app out provided by Blue Leaf, which is our portfolio management and performance software. If you are an Edgar investment client, you can go to the App Store on iPhone or on Android and download the My Financial Advisor app, log in with your Blue Leaf credentials, and all of your investment information will be right there. So you can review your portfolio balances, look at holdings, and just kind of see how markets are impacting your investment. And then we also have a brand new investment model called the Edgar Sector Rotator. And we'll talk a little bit more about this in a few minutes, but this is basically looking at the 11 sectors of the market, of the S&P specifically, and using quantitative metrics to make predictions on what sectors we believe are going to perform better versus sectors that are going to perform maybe not as well. But we'll talk about that a little bit here in a few minutes. So some hot topics. So what happened in Q2 of 2023? Well, this seems to be sort of the perennial hot topic is the Fed funds rate. So what is the Fed doing with regard to interest rates? Now, as a reminder, in 2022, every meeting we got an increase in interest rates. So we came up off of basically zero and started off 2023 at over 4%. So this slide here just shows you, kind of where we've been throughout the year. So we've had 4 meetings so far this year. 3 of those meetings have resulted in increases. The most recent meeting in June, there was a pause, a very sort of infamous pause. You can see here what the Fed target rate was at each of those meetings. So we started off the year at around 4%. And we've gotten ourselves up to about 5 to 5.25. Inflation has cooled down. That's not to say inflation is tamed. Last year we saw the highest inflation print in basically 40 years. That's come down. We're no longer, breaking records in terms of inflation, which is good. But that's not to say that the inflation dragon has been tamed. Around here at Edgar Investment, we think that we will probably get at least 1 more increase this year, maybe possibly 2. I know there are some folks out there that think we're going to get a decrease in rates in 2023. I don't personally see that happening. But That being said, nobody really knows what's going to happen. I don't know that the Fed quite knows what is going to happen. So take that with a grain of salt. But this is where we've come from this year. Another big story in Q2 was the debt ceiling debate. So as a reminder, the United States government has to issue additional debt periodically to finance government spending, defense spending, entitlements, things like that. The Congress has to authorize an increase in that debt ceiling or authorize additional debt being issued. And what we saw in the second quarter is this became sort of a political debate. It's become more of a political debate over the last few years. It never used to be any sort of debate at all, but it's become more of a debate over the last few years, really culminating in quite the scary situation in Q2. In fact, some rating agencies, and we'll see here in another slide, some rating agencies actually threw out there that they were potentially going to downgrade the U.S. debt, which would have been a pretty big situation. It would have been even a bigger situation if we would have defaulted on our debt. We did not do that in the end. There was an agreement that came to pass, and we increased our debt ceiling, and we avoided some serious problems. Is this issue fixed? It is not fixed. I have no doubt in my mind that we will be talking about the debt ceiling at some point in the future. It is not a resolved issue by any stretch of the imagination. Every quarter seems to have a lot of volatility. Excuse me. Every quarter seems to have a lot of volatility. Did Q2 have more volatility than normal? We're going to take a look at that in a little bit more detail. So I'm not going to tell you the answer to that question quite yet. And then a really big story in Q2 was just sort of the blast off of NVIDIA. So NVIDIA is a graphics processor company. They have benefited quite substantially from two macro sort of trends in the last 10, 15 years. So you can see down here at the bottom of this slide, this is the price for NVIDIA. In Q2, they entered the $1 trillion club. The company is now worth $1 trillion plus. And you can see they had a spike a few years ago in their value. And this was when everybody was buying NVIDIA because they thought, crypto was going to take off and miners needed processors. Specifically, they liked the graphic processors that NVIDIA had. They had to get those processors to mine crypto. So you can see NVIDIA's stock price just shoot up during the crypto thing, kind of abated and came back down. And then it's taken off again, this time not so much on crypto, but this time it's on AI. So if anybody out there is familiar with ChatGPT, there's a real sort of excitement around artificial intelligence sort of coming out to the masses. And NVIDIA, it's presumed, is going to supply a lot of the processors to run those AI applications. So investors are really getting out ahead of this and saying, hey, NVIDIA is going to just take off. I'm not so sure about that story. I think NVIDIA is probably going to do pretty well. I don't know about this valuation. I think the last time I checked, NVIDIA was trading at a pretty high multiple to sales. And the valuation seems a little bit high to me right now. But it's something to be watched. So let's talk a little bit more about market volatility. So we've got two graphs here. On the left-hand side, you're going to see volatility for the second quarter going back to 2013. So this is only volatility in Q2. So Q2 of 2013, 14, 15, etc. And what you'll see there is a black horizontal line that shows us our average standard deviation of volatility. So that's sort of a measure of the average volatility in each year. And what you'll see is 2023 didn't really have, relative to the average, it really didn't have much volatility at all. In fact, the really interesting thing about this chart is 2020 and 2022 had huge amounts of volatility. So 2020, obviously, Q2 was COVID. in March of 2020, we hit a really low, and then the market just took off. There's a lot of volatility in that takeoff. 2022, on the other hand, was the Fed beginning to increase interest rates and inflation peaking. So there was a lot of volatility around that. And in fact, if you remove 2020 and 2022 from the data set, that average standard deviation line basically falls down considerably, and 2023 is right in line with that. So the moral of that story is that in Q2, we didn't really see a huge amount of volatility in terms of excess volatility over what we would have normally expected. However, if you look at the chart on the right, that looks at average daily returns for the second quarter going back 10 years. And again, you'll see in 2020, just the average daily return was sort of out of this world. So we had a lot of volatility and we had a lot of return. 2022 is the exact opposite of that story in terms of return. We had a lot of volatility and we had really bad returns. What you can see with 2023 is while we didn't have a lot of volatility, we actually had fairly robust returns. So if you were watching the markets on a daily basis, we just sort of plodded along each day, going up, going up, going up. So in general, it was a very good quarter for investors. Not a lot of volatility and a good amount of return. So let's take a look at some different markets kind of across the world for the second quarter. So what we can see is the U.S. stock market performed really well relative to its peer markets, but also relative to historical. So you can see 8.39% on the U.S. market versus international developed markets, which had 3.03, just a little over 3%. And then emerging markets came in just under 1% at 0.9%. Global real estate had about 7.71% increase. But when you look at this historically, both the U.S. market and developed markets were up relative to their historical average, with the U.S. being significantly up. So the U.S. Q2 average is 2.3%. We hit 8.39%. So a very good solid quarter in terms of returns. Same thing for international developed, average of 1.5%. We hit 3%. So a very good quarter for international developed markets as well. Emerging markets, on the other hand, underperformed itself on a historical perspective. So 2.5% is what we normally would expect in Q2 on average for emerging markets. We eked out a little less than 1%. Same thing for global real estate. We would normally expect around 2%, a little over 2%, and we got just under 1% on global real estate. So the shining markets this last quarter, were the U.S. stock markets and developed stock markets. And we'll take a look at a little bit more detail on those two markets here in a second. U.S. bond market was down 84 basis points. Bonds have had a tough go of it. 2022 was the really tough year for bonds, and that is just because of increasing interest rates. So as a reminder or new information, if interest rates increase, bond prices decrease. If interest rates decrease, bond prices increased. And there's two returns that you can pull from a bond. You can pull your coupon return, which is whatever your interest rate on the bond is. But you also have a return from the increase or decrease of the value of your bond. And so that's what we're seeing happen in the bond market is interest rates have gone up, bond prices have come down. So that value of bond holdings has gone down. A little bit of a different story on the global bond market outside of the United States. We did see a modest return of 73 basis points, a little bit less than average, what we would normally expect to see in the global bond market. But if you're a bond investor and you're well diversified, to some extent, you maybe had some offset from the global bond market. versus the US. But overall, a pretty good quarter across the board for equities, a little bit more of a mixed bag in terms of fixed income. Let's look at a little bit longer term perspective here. So same exact categories: US stock, international developed, emerging market, global real estate, US bonds, and global bonds minus the US. The 1 year return on the US stock market is a very hefty 18.95%. Developed markets, even though in the second quarter they didn't quite hold up to US markets, they're actually performing pretty well versus US markets, up 17.41%. So there again, US and international developed over the last year, really doing well. Emerging markets, not so well, 1.75% for the last year. And then global real estate is actually down for the year, a little over 3%. US bonds for the year are down. That's really just sort of, effects from 2022. But the overall global bond market minus US is up. 5 year returns, sort of the same story. What you see in 5 year returns is the US market is really outperforming the developed market by a fairly substantial margin, much better compared to emerging markets. And what we've seen there, I think, is that, as global investors feel like their options in other countries aren't quite as robust, that money flows out of those international markets and flows into the United States. So the US markets benefit when investors abroad get scared, or when US investors decide that they're going to pull back some of their money from other markets. So that's what I think we've seen over the last 5 years. I think we've also seen that probably in even more greater sort of effect at the 10 year. So if you look at the 10-year US stock market, we're returning 12.34% per year, whereas in international developed, it's only 5.4. So the US market has really outpaced international developed and has really outpaced emerging markets as well. And I think that's just sort of a supply and demand, sort of effect going on there, as well as other things. I mean, there's a lot that goes into the prices of markets, but I think as investors globally, sort of have some fears about things, they tend to move their money to the United States because it seemed to be more of a safe type market. The 10-year bond markets, US bond markets are up 1.52%. Global bond markets without the US are up 2.48%. And there is a reason for that. There is more risk in the global bond market. So you would hope that you would see better returns in the US global market, and you do. But if you're a fixed income investor, the last 12 months, 18 months have been a pretty big challenge for you. So let's take a look at some of the sort of key points throughout the last 3 months. I'm not going to talk about all of these, but I'm going to hit a few of them. So very early, sort of in the quarter, US inflation began to ease. We say in the slide it began to ease. It eased to 5% in March. While 5% inflation historically, when I say historically, I'm talking about maybe the last 15 to 20 years, 5% seems pretty high. It was the lowest that we had in 2 years. So we did have, some substantial inflation for, a period of time. So seeing that come down to 5% was a little bit of a sort of a happy thing to happen, even though it's still pretty high. This is dusting off the memory banks. We've all sort of forgot about the bank failures in the early part of Q2, specifically Silicon Valley Bank. This was, I think, the third largest bank failure in US history. There was a lot of concern at the time that this would be a sort of contagion event, that on top of everything else we had, that the bank failures were going to start to roll through the banking system and we would have a banking crisis. That did not materialize. We did have some other bank failures, some fairly large ones, small ones, But what we didn't see is we didn't see wide scale, runs on bank. We didn't see, large bank failures. And in fact, pretty much all banks, I think, at this point have gone through their stress testing with the Fed. The banking sector is very healthy. I think that Silicon Valley Bank is a very unique situation. It's a bit of a run type situation. People were chit-chatting about SVB, saying, "Hey, you need to get your money out of there." And when you have a true bank run, it's very, very, very difficult for a bank to prevent, you know, sort of catastrophic things. When your deposit holders lose confidence, it's just a bad thing for the bank because banks don't hold all of their deposit money on cash. So if you have 50% of your depositors say, "I want my money back," it's a bad day for the bank. But in general, I think we sort of averted any sort of crisis there. I don't think there was a crisis to begin with, so maybe there was no crisis to avert. Um, Midway through the quarter, S&P hits a 2023 high, but then we begin to sort of focus on the debt ceiling. And we get Fitch, one of the main rating agencies, starts talking about potentially downgrading U.S. debt. We did see U.S. debt yields start to increase, meaning the bond prices came down because the rates were getting higher, because there was some real genuine concern that the U.S. government would not be able to pay its debt holders, which would have been unprecedented and catastrophic. We also saw, this was sort of in one of the earlier slides, we saw that the Fed decided to hold interest rates steady, but they do expect more increases. So this is something that, we talked about the pause at the last FOMC meeting, the Federal Open Market Committee meeting. They did pause, but they did signal that they are ready to increase rates more. Now, there are a lot of investors out there that are sort of not maybe taking the Fed at its word and still thinking that they're going to decrease rates. What we believe around Edgar investment, and obviously you need to talk to your professionals, what we believe around Edgar investment is that inflation is still too hot and heavy for the Fed, and employment is still at a very robust level. So the Fed has what we call a dual mandate, and this is unique among central banks. Most central banks, their mandate is to regulate inflation, and the way that they regulate inflation predominantly is through the interest rate. There are other mechanisms that central banks have. The U.S. central bank, the Federal Reserve Bank, has a dual mandate. And what that means is that mandate number one is to regulate inflation. Mandate number two is to achieve specific employment objectives. And right now, we are basically at full employment. We may even be above full employment. Anybody that's been to a restaurant or has had bad service at a place sort of knows, there's employment is doing just fine. And so I believe that what that allows the Fed to do is sort of not necessarily ignore the employment mandate, but maybe demote the employment mandate and sort of say, well, we don't really need to pay too much attention to the employment mandate right now because we're doing okay as an economy, and let's focus on that inflation. So we do expect to see some more rate actions. I mean, we still have half the year to go, so we shall see. But they did pause at this last meeting. And then at the very end of the quarter, the NASDAQ had its best first half of the year since 1983. So, there again, the US markets did very well in the second quarter. The NASDAQ actually had a record month, or at least a record since 1983. Going back a little bit further in terms of timeline, looking at the last 12 months, around this time last year, we were hitting record numbers in terms of inflation. We hit a print of 9.1%. We hadn't seen 9.1% inflation in 40 years. I mean, in fact, a lot of a lot of our population, a lot of investors, a lot of people working in markets have never seen that sort of inflation. If you were working in investments the last time that we had this sort of inflation, you're probably in your 70s or 80s by this point. So it was definitely unprecedented in terms of most people's lifetime. We also did see interest rates, or mortgage rates, I should say, climb last year. They topped out at 6% for the first time since 2008 financial crisis. That hasn't seemed to impact prices on housing as much as I think there's maybe less supply coming out. What that did do is it sort of locked a lot of homeowners into where they are, because with rates going up, you may be in a mortgage that has 3%, but if you sell that house, you also sell that mortgage, and now you trade into a new house at 6%. You may buy a smaller, cheaper house and have the same mortgage payment. So I think a lot of homeowners looked at that sort of dynamic and said, we're not going anywhere, because we're not gonna have the same mortgage payment and less of a house. And so I think we've seen that sort of happen. And I've talked to real estate agents, and it does seem like things have sort of cooled down from some of the heavy markets that we saw, especially coming out of the pandemic. And then U.S. Treasury yield curve inverts to the deepest level since 1981. Just sort of put that in your memory bank for a second. We're going to talk about the yield curve here in a few slides. But definitely some very interesting things happening on the yield curve. It's all a function of the Fed changing interest rates, but some very, very interesting observations to make on the yield curve. So a great slide. I love this slide for a lot of reasons, but let me first tell you what this slide is. So this slide is country returns for the quarter. Now, most of us, I think, are probably in the US on this call. So that red bar, that is the US performance. The blue bar is the global performance. So you can see the United States performed better than sort of that global basket of countries. So obviously on the left, we have our number one performers going all the way over to the right. We have our performers that perform the worst. And so you can see our top countries in terms of performance for Q2: Greece, Hungary, Poland, Brazil, and India. I can't think of a lot of investors that going into Q2 said, you know what, I'm all in on Greece or Hungary or Poland. So, to me, what this slide really does a good thing. It sort of demonstrates you're never really sure country-wise where your returns are going to come from. Are they going to come from Greece? Are they going to come from Italy, Egypt? You don't really know. And so this really speaks to the idea of diversification across countries, not just across industries or sectors, or even your value growth, but really diversification across all different sorts of metrics. Because if you had a little bit of Greece in your portfolio in Q2, that really helped you out to quite an extent. I will also say something very interesting on this chart. If you look down towards the very, very bottom, all the way over on the right, you will see a pretty large market there called China. China was our second worst performing market in Q2. That's a pretty big market, a lot going on in China. That's a pretty interesting development. So I really love this slide. Country returns are fairly unpredictable. I have no doubt that when we look at this slide next quarter, we're going to see something very different. So I'm anxious to get to that point. So let's talk a little bit about the Edgar sector rotator. I sort of previewed this early on. So what this is it's a model that we've come up with here at Edgar Investment, and it looks at a whole host of quantitative factors, a whole host of quantitative measures, both macro, micro. There's some momentum factors involved in this. And it says ultimately what we're trying to do is we're trying to take each of the 11 sectors in the S&P. So the S&P is made up of 11 sectors: materials, communication services, energy, financials, industrials, information technology, consumer staples, real estate, utilities, healthcare, and consumer discretionary. And what our model does is it looks at a whole host of data, all quantitative. This is a quantitative model. And it says, it processes all that data and it says, we think these sectors are going to outperform and we think these sectors are going to underperform. And what do we mean by outperform or underperform? Well, all of these sectors make up the S&P. So the S&P is kind of your benchmark. Well, what sectors specifically are going to do better than the S&P and what sectors are going to do worse than the S&P? They all may go up, but what sectors relative are going to go up more versus less? And then what we do is we sort of process all that information and then we make predictions based on what we think. And those predictions turn into weightings. So if you look at this chart here, for each of the sectors, sort of that dark blue line on the left is that sector's weight in the S&P. Now, when we talk about the S&P, we use an ETF called SPY, which is the Spider S&P ETF. So we look at it at that sector's weight in the S&P. So that's the sort of the green line on the left. And then that dark green line in the middle is what we are weighting that sector in our portfolio. So we could either weight it the same as the S&P, we could weight it more, or we could weight it less. If we think that that sector is going to outperform, then we overweight it. If we think it's going to underperform, then we underweight it. At the end of the quarter, if that sector did well and we overweighted it, then that's a win. If the sector did poorly and we underweighted it, that is also a win. If the sector did well and we underweighted it, that's a loss. If the sector did poorly and we overweighted it, that's also a loss. So what you see then here on this slide is that sort of light green line is the difference between the sector weight in the S&P and our weighting. And so essentially what we're saying here is that we believe materials, energy, financials, industrials, consumer staples, real estate, and utilities and healthcare should be underweighted. They may still go up, but we don't think that they're going to go up as much as we think communication services, information technology, and consumer discretionary. So we think those sectors are going to outperform, so we've put more weighting on those sectors versus the other sectors we think are going to underperform, so we put less weighting on those. Now, we've actually got some money running through this model, but this is a brand new model for us for Q3. So what we'll do every quarter on this call is we will bring in an additional slide where we compare and we say, this is what we weighted it at. This is what it did. Was it a win? Was it a loss? Is it a sector that performed well and we overweighted it? Or is it a sector that performed well and we underweighted it? That would be a loss. So we will account for this sort of model on a quarterly basis. Q3 is our first time we've done this, so we don't have that slide because we haven't done this before. But in back testing, it's performed pretty well, but you'll never find a model that doesn't perform well in back testing. So take that with a grain of salt. So this will be something we'll watch on a quarterly basis. So let's talk a little bit about US stocks and where the returns were coming from. So as we've already talked about, US equities posted very positive returns for the quarter, outperforming developed, outperforming emerging. Growth was our big winner in Q2. Growth stocks are those sort of high-flying stocks. They usually don't pay dividends. They have high multiples. Think of your technology stocks like NVIDIA, Apple, Google, Amazon. Those tend to be your growth stocks. Your value stocks are more sort of your utilities, your AT&T, your Verizon. Growth outperformed value for the quarter. Small caps also underperformed large caps. So when we talk about caps, we're talking about market capitalization, and that's just the size of a company. Large cap are your large companies like Nvidia, like Apple, like Amazon, like Exxon. Those are your large cap stocks. Small cap stocks are, those names that you probably never heard of, or if you have heard of them, it's because you're watching the market too closely. Large cap growth just devoured everybody else. You can see 12.81% returning for large cap growth. Small cap value was up, but it was only up by 3.18%. Overall, you can see the U.S. Markets make up 61% of the global market. So, the U.S. market is sort of that 10,000 pound gorilla. It is the market that kind of rules all markets. In fact, the US market has companies like Nvidia and Apple that are bigger than other stock markets in their entirety. Let's take a look at international developed stocks. So again, international developed did well. It didn't do as well as US markets, but it did well. Again, here, the very same story as US markets. Value outperformed growth. Again, large cap outperformed small cap. So what we saw on the developed side is pretty much the same thing that we saw on the US side. What you'll see here on the right side of the screen is we have two measures of return. So we have local currency and then we have US currency. This is just the difference between those two is the effect of exchange rates. So if you were to, invest in a foreign currency, in a foreign company, in a foreign currency, and leave your money there, and it's a value stock, you would have gotten 4.09. But if you converted that back to US dollars, you would have lost some money in the change in the US currency rate. So you would have gone from 4.09 down to 3.12. So it's just a measure of US returns that accounts for currency changes. And you can see the international developed market makes up 28% of the global stock market. Emerging markets, a little bit different story here on emerging markets. So, obviously we've talked about this a couple times. They did post positive returns, but they underperformed the US. They underperformed US developed. But here in emerging markets, value actually outperformed growth, and small caps actually outperformed large caps. So sort of the opposite story in terms of where those returns were coming from on the emerging market side. So again, a really good case to be made for diversification, right? If you just said, I'm a large cap US investor, yeah, you did really great, but diversification sort of evens things out, sort of helps with the ebbs and flows of markets, and you never really know where your returns are ultimately going to come from. So let's take a look at the global fixed income. Really, really interesting things happening here as far as fixed income goes. If you can be interesting in fixed income, what you'll see is all global fixed income markets, with the exception of Japan, have inverted yield curves. So what does that mean, inverted yield curves? Well, let's take a look at the US yield curve at the very top middle there. So a yield curve basically plots your interest rate by maturity. So as you go along the x-axis, the longer maturity, the further out the x-axis you get. And then you have yield on the y-axis. Typically, what we expect to see with fixed income is an upward sloping yield curve, meaning that interest rates on the short end, so shorter maturity fixed income has lower rates versus longer dated maturities. And this makes sense sort of from a time value of money standpoint. If you're going to loan somebody money that matures in a month, you're probably going to need less of a premium than if you're going to loan somebody money for 30 years. That's not what we saw in Q2. What we saw in Q2 is shorter maturity fixed income had a higher rate than longer dated maturity. And that's inversion. That's what it means to be inverted. And I think what's going on there is fixed income investors just don't believe that the Fed is going to hold rates at this level. Is that, maybe they do this for 3 months or 6 months, who knows, but it's not going to be a long-term sort of situation. So there's a lot of pressure, upward pressure on the short maturity, but that pressure is not quite as heavy on those longer dated maturities. They all rise up, but there's more of an increase in that shorter maturity. Now, if the Fed were to come out today and investors believe them, and the Fed was to come out and say, look, we're going to keep interest rates right where they are for the next 30 years, well, boom, you would see that yield curve change almost instantly. It would be a pretty interesting day in the markets if they did that. What you will see from this chart is that from the beginning of the quarter, basically from the from March 31st to the end of Q2, we did see a little bit of a shift in interest rates up, but we saw more of a shift in those shorter maturities. So it'll be interesting to see as sort of the Fed sits on this rate, do we start to see that bulge start to push out the curve a little bit? We did see that a little bit in the second quarter. So very interesting sort of things happening on fixed income. Anytime you have an inversion of the yield curve, it's very interesting. This slide, if you focus in on the very middle of this slide, U.S. Treasury yields curve, you're going to see exactly what I'm talking about. 1 year ago, we had a sort of a normal looking yield curve. Short maturities were lower. As you moved out, they got longer. They got higher. Some point between June 30th, 2022 and March 31st of 2023, that flips. And you can see it inverts. So very, very interesting yield curve happening. Well, I'm at 10:42 Central Time. That sort of concludes that part of our presentation. But I wanted to go ahead and address some questions. We had some really good questions sent in whenever they registered. So as a reminder for the next webinar, whenever you register, there is a spot to put your questions. If you put your question in that spot, that gives me time to actually put together some slides and really address your question. So I'm going to start out. I got a question submitted. How should an investor navigate volatility in markets created by the Fed with respect to increased rates? That's a great question. I think that markets don't just respond to an increase in rates. Now, increase in rates has been the story now since the beginning of 2022, but markets also have increase in volatility from geopolitical events such as Russia invading Ukraine or pandemics. Obviously, we saw a lot of volatility from pandemics. Financial crises, just a whole host of events can increase volatility. So instead of sort of, just focusing on the Fed, I'd kind of like to focus a little bit more on volatility and how can investors navigate volatile markets? Because I think that's a great question. And what I've got here is I've got a slide. I've got a few slides on this. And this slide sort of shows you if you were to invest $1 in 1926. So this looks at the period 1926 to 2022. Now, I will admit that time horizon is longer than most people's time horizon. Most people don't have a nearly 100-year time horizon. But this sort of gives you the idea of how things can be affected by time. If you were to take $1 and invest it in U.S. small caps, in 2022, that $1 would have grown into $28,600. If you would have invested in U.S. large cap, that would have been $11,527. If you would have just been fairly conservative and invested in long-term U.S. government bonds, that $1 would have turned into $131. Even treasury bills, which are shorter term maturities, don't offer quite as much return, you'd have $22. Inflation would have been $17. So through inflation, that $1 would have turned into, you would have needed $17 in purchasing power. So even if you took the most conservative sort of investment you could, investing in T-bills, you would have at least outpaced inflation, not by a lot, but by a little bit. Um, in fact, this is it's such a huge effect that this is, if you'll notice, this is a logarithmic scale because U.S. small cap has grown so much over the last 100 years. So I think the idea here with regard to volatility is you really want to keep a perspective on your actual investment time horizon. All investors have an investment time horizon. Most investors are saving for retirement, or they're saving for college, or maybe they're saving to start a business, or they're saving to pass along some sort of legacy as part of their estate. So it's really important to focus on whatever that time horizon is. So if you have a 25, 30-year time horizon, you're thinking about your working years and what you're going to do when you retire, paying attention to a lot of volatility doesn't necessarily make sense. Um, I will also say, if you are paying attention to sort of the volatile markets, it helps to keep a perspective on what types of volatile markets we've historically seen. So this chart shows you sort of bull markets versus bear markets. And there's two things to really notice in this slide. And I'm not going to go through all the detail of, how long this bull market lasted, how long that bear market lasted. I really just want to sort of pay attention to the visual here. What you'll see is that there are more bull markets than bear markets. There's just more blue than red. So the quantity is more bull than bear. But it's not just the quantity, it's also sort of the level of markets. There's more bigger bull markets than there are bad bear markets. So it's not just the quantity of bull versus bear, but it's sort of that peak to trough, if you will. So when you're stuck in one of those little red bars, it doesn't feel good. Bear markets never feel good, but it helps to sort of keep perspectives that, hey, you know what, bear markets end, and this too shall pass as well. Sort of taking sort of that same idea and just sort of looking at markets from 1926 through 2022 and graphing negative years and positive years. 3/4 of our years since 1926 have been positive years. A quarter have been negative years. And if you really dug down into this detail, what you would find is a lot of those negative years are followed up by very positive years. So really sort of keeping your perspective on, hey, yeah, this isn't a great feeling market right now, but I'm invested for the long term. My investment horizon is 20 years, is 30 years, is 10 years. I'm not so concerned about what's happening today on CNBC or one of your other financial news stations. The other thing too is, this does a really nice job, this slide, of looking at sort of bad things that have happened since 1970, right? There's been all sorts of things that have happened from 1970: embargoes, wars, inflation, pandemics, crises, dot-com crashes. I mean, there's just all sorts of really bad things that have happened. And if you pick up a magazine or look at a news feed, you're really going to get hounded by those bad things. And what you find is that since 1970, markets have said, yeah, okay, yeah, that's bad, but let's keep going up. That's bad, but let's keep going up. Markets just tend to go up over long periods of time. So not getting caught up in, the Asian currency crisis of the late 90s and realizing, hey, you know what, the market's going to process it and we're going to be moving on. And no doubt we'll be on to the next crisis, but markets are just going to sort of continue to move on as well. And then we did a little bit of research here in the office, sort of wanted to kind of frame things a little bit differently, maybe more sort of from a behavioral standpoint. So we took, and I say we, Patrick Klein, who's in our office, he took the last 10 years of the S&P 500. And he broke up the S&P 500 into different time periods: daily, weekly, monthly, quarterly, and annually. And he looked at what the return for those different periods are. So what's the daily return, the weekly average return, the monthly average return, quarterly average return? And what you'll see here is the average return per day, the average return per week, per month, per quarter, per year. Then what he did is he said, well, what's the standard deviation of those returns for that period of time? So let's just take a look at the daily. On the daily, you get about 5 basis points of return on average per day. But there's a standard deviation, right? There's a movement along, sort of that return of plus or minus 1.1%. Going down, skip down to like the quarterly. On average, your quarterly return is 2.83%, but there's a standard deviation of about 7.62%. Going down to the annual return is about 2.82% with a standard deviation of 7.93%. Then we took that as a ratio and we said, what is our volatility to average return? So how much volatility are you getting per unit of return? Okay, so how much volatility per unit of return? So you can see on that daily, you have 23 times more volatility per unit of return. And as you move down to different measurement periods, that goes down. So if you look at the annual volatility for unit of return, it's only 1.4. Now keep in mind, this is all the same data. So you start at point A and you get to point B. These are all the same data, A to B, but we're looking at different little increments of measurement: daily, weekly, monthly, quarterly, annually. And what becomes pretty obvious when you do this is that the more frequently you watch markets, the more volatility you perceive, the more volatility you experience, because you're getting more volatility per return that you're looking at. So I would say, not to be trite about it, but I would say if anxiety in the markets, or if you get anxiety from the markets, maybe scaling back and looking at it a little bit less and realizing that markets generally increase, markets accommodate for financial crises and all kinds of other bad things, and maybe looking at your portfolio a little bit less frequently, you'll experience less volatility. Because whether you're experiencing that daily 23 times volatility or experiencing 1.4 times on the annual, it's the same return over a long period of time. So it's a difference in experience. But that's a great question, and I love that question because it really speaks to sort of the mindset of an investor. So great question. Thank you for that. Another great question: any insights on oil and gas commodity pricing? M&A would be great. This is definitely not an area of expertise with us, but I will say we have some points to make on this. So what we did find in Q1 of 2023, that's the best data I think we have at this point. Q1 2023, oil and gas deals were down by 35% over Q4 of 2022. There were 74 oil and gas deals in the first quarter. The dollar value is down 47%. That made up $14.8 billion in Q2. And you can see on this chart on the right, there's been a downward trend in oil and gas M&A activity. What's that a function of? I think there's a couple things that are feeding into that. There's been a little bit of a push for decarbonization. I think probably more significant than that would be higher valuations. Equity prices are up. But in addition to that, as we've seen interest rates come up, the cost of borrowing has come up. Most M&A deals are a combination of equity and debt. As that debt price comes up, it makes certain deals just not profitable. So, you get to a point where your IRR doesn't exceed your cost of capital. I think there's also something else really interesting going on with the crude oil futures market. So when we look at futures, we look at the price of a barrel of oil delivered tomorrow or the next day, or the next month or the next month. Normally, that curve would be upward sloping. A barrel of oil in a year costs more on the futures market than a barrel of oil on the spot market today or a barrel of oil in 1 month. That's changed recently. That's called contango, an upward sloping market. That market has gone into backwardation. Our current oil prices are higher than future oil prices, and a barrel of oil next month costs more than a barrel of oil in 2 months, and so on and so forth. And when companies are running their economics on valuations, they're looking at that futures curve. And when oil prices are going down and they're discounting that future revenue back to current prices, it's just it all kind of culminates in a very, very challenging market for M&A opportunities. Now, I will say, since we're talking about oil and gas, if you're an equity investor, there are potentially some attractive factors to oil and gas investments. Now, obviously, you want to consult with your professional. These are not specific recommendations. They're just examples. I'm not recommending these companies. I'm just sort of highlighting them because of some interesting factors, I think, with regard to their dividend yield. So if you look at ExxonMobil, it has a 3.43% dividend yield. If you look at Valero, it has a 3.5% dividend yield. So if you buy one of those companies today, you sort of anticipate, if you assume your dividends are going to maintain, you anticipate that's your sort of your bottom line return. In fact, if you look at the S&P energy sector, we use a proxy Energy Select Sector XLE. It's a 3.95% dividend. Compare that to the S&P sort of market-wide dividend of 1.47%. So if you're a value investor, oil and gas is probably continues to be a place that you want to focus in on. And then I am running short on time, so I've got one more question that I want to address. So how do you see the ongoing negotiations of global steel and aluminum arrangements between the U.S. and EU affecting investors? Good question. So very, very specific. So, what's this question sort of based on? U.S., EU, steel, and aluminum. So what happened there? So the Trump administration had put sort of punitive tariffs on EU sourced steel and aluminum. In late 2021, the US and the EU agreed to roll those punitive tariffs back on EU sourced steel and aluminum. And then the EU agreed to remove some of the retaliatory tariffs that they had placed on things like bourbon and motorcycles. That agreement also, which is still, I believe, being negotiated, but that agreement also addresses some climate policies. It also addresses some disputes that the US and the EU had in the World Trade Organization. It is not a free trade agreement. There's still going to be a tariff. It's based on historical import rates and things like that, and gets pretty complex. But so it's not a free trade agreement. But it is interesting because it's a little bit more, accommodative to it seems like to EU sourced steel and aluminum. But I will say what this question asks is, what is investors sort of feeling about this? I will say investors don't like tariffs. Tariffs distort prices, right? Ultimately, an investor would like free trade, global free trade, because then you get competitive and comparative advantage in terms of, pricing. They don't like tariffs because they distort tariffs. That being said, the lower the tariff, the better. As you get closer to zero, that gets better. But in the absence of having zero tariffs, I think what investors do like is certainty. Certainty is always better than uncertainty. So if you have a situation where, all parties agree, and this is how it's going to be, and, there's not going to be any disputes, we're going to settle all of these things, then I think investors like that sort of certainty. Certainty is always better than uncertainty. And, with regard to sort of confidence, because there was that question sort of hits on confidence. We do have sort of a different metric between investor confidence and consumer confidence. And I will say just on both of those, we see things getting better. Investors are having, increased confidence. In fact, consumer confidence has hit a record level since January of 2022. So consumers are feeling much more confidence, especially amongst 35 and under. So our younger consumers are feeling more confident, and income or households that make more than $35,000 are feeling more confident. So in general, confidence seems to be increasing. I think there's still a lot of weakness in certain parts in terms of confidence, but there seems to be an increase in confidence. Well, I am right at 11 o'clock, so I don't want to take up anybody's, I don't want to take up any more time, but I do want to say thank you to everybody that tuned in for this quarterly update. We're going to do these after every quarter. I hope you enjoyed it. If you have any constructive criticisms, feedback, you're going to get a survey after the webinar ends. We would love for you to take that survey. Give us some feedback. Let us know how we did. Let us know what we can do better. What you'd like to see in future webinars. You can always find us, on social media. We're on Instagram, Facebook, LinkedIn. You can always hit up our website. You can give us a phone call. But anyhow, I'd like to thank everybody for attending, and I hope you have a great Q3. It's off to a pretty good start, so we'll just keep that going. So thank you all for attending.